Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen presented in 4 minutes or less. The FOMC drew a line in the sand saying to Lehman, no funds for you. Then they facilitate the U.S. purchase of AIG, kicking sand into that line. My first blip explains the fallout with regard to Lehman, AIG, Bank of America, and Merrill Lynch. With regard to Lehman, the U.S. Treasury and Federal Reserve tried to force a shotgun wedding of Lehman, first to the Bank of America, then to Barclays. Both B of A and Barclays left Lehman at the altar as the Federal Reserve refused to provide a dowry similar to the Bear Stearns $29 billion lifeline. Bank of America and Merrill Lynch were already in a courtship, and by contributing $7 billion each to the Investment Banking Rescue Fund with 8 other firms, the regulators supported their request to merge. In my opinion, the regulators had no choice but to support this deal, as Merrill Lynch appeared next in line in terms of assault by market skeptics. Both stocks rallied on Tuesday. U.S. taxpayers now own 80% of AIG in exchange for a 2-year $85 billion bridge loan. AIG will repay this loan as assets are liquidated. U.S. taxpayers now have equity in AIG, Fannie Mae, and Freddie Mac. In the meantime, the FOMC left the federal funds rate at 2%, which had Wall Street booing. I applauded this non-move as a sign that the Fed no longer cares where Fed fund futures are trading. My second blip is my opinion that Washington Mutual cannot be allowed to fail. The regulators need to react proactively to save Washington Mutual and not allow the 5th largest bank by assets to fail, as such could result in a run on the banks to protect uninsured deposits. The lower U.S. Treasury yields, in my opinion, are a flight to quality out of U.S. bank deposits. The yield on the 30-year plunged below 4% to 3.818 on Tuesday for the first time in the new millennium. WaMu's Achilles heel will likely be $53.9 billion in option-arm mortgages, which are highly likely to fail. With this toxic mortgage, a borrower paid a rate of as low as 1% for up to 5 years by allowing the loan principal to increase by as much as 120% of the original mortgage amount. Steep resets are starting now, and with lower appraised values for properties, defaults will be significant. As an FYI, Wachovia reported $122 billion of these toxic structures in their portfolio at the end of Q2. My third blip describes the lifelines that the FDIC should use now to avert a run on the banking system. The FDIC covers the first 100,000 in deposits held by each individual in a given bank. As of June 30, there was $7 trillion covered by the FDIC insurance and $2.9 trillion in uninsured deposits. Inflation alone should be enough to increase this coverage, but the FDIC can and should request a full guarantee of all U.S. deposits under a law passed in 1991. A request by the FDIC requires approval of the Federal Reserve Board and the U.S. Treasury in consultation with the President. The FDIC refrained from using this facility in the 1988 to 1992 crisis. WaMu has $143 billion of insured deposits at the end of the second quarter, about 3 times the size of the $45 billion deposit insurance fund, which is well underfunded. The FDIC will be asking ailing banks to pony up more money over the next 5 years to raise the fund back above 1.15% of insured assets, which is required by law. This is tough to do when smaller banks are lining up like dominoes, just waiting to fail. The FDIC has 2 lines of credit with the U.S. Treasury, a direct $30 billion line that has never been used, and a $40 billion line to the Federal Finance Bank a U.S. Treasury borrowing facility. The FDIC uses small amounts from the Federal Finance Bank to fund illiquid assets picked up when a bank fails until these assets are sold. These can be furniture to full buildings and such. In my opinion, the Federal Finance Bank can begin to auction securities to raise funds both to support the FDIC and to insure all assets to prevent a run on the banking system. Please do so now and act preemptively. My fourth blip shows the monthly and weekly charts for the Dow Industrial Average. The Dow is trading between its 120 month at 10,626 and its 200-week simple moving average at 11,751. A monthly close below the 120-month simple moving average signals a multi-year bear market. Yesterday's low of 10,742.70 was a successful test of my annual support at 10,747. I aggressively defended that support and that it would hold during yesterday's trade, both before the Fed action and after the Fed action. A similar annual support held following the crash of 1987. Keep in mind that a monthly close below the 120-month simple moving average would be the first since July 1982. If you have any comments or questions or want to order a copy of my special report covering the great credit crunch, shoot me an email, gmcreports@aol.com. That's today's 4 and 4. Enjoy your day.